So, what is a derivative? Well, first of all, they're a crucial part of financial markets at the moment. The UK does massive business in derivatives in particular, and they are, as the name suggests, products that derive their value from something else. Derivative. But what would that something else be, and how would they work, and how would they be used? That's what I'm going to cover today. Okay, that word, derivative, so something that derives its value from something else. Well, what's an example? People often use derivatives without even knowing they're doing it. Take a friend of mine. He put down a £5,000 deposit, if I remember rightly, a few years ago to join the waiting list to buy a limited edition sports car to be released a year later. Lots of other people did the same, and the waiting list quickly closed. It was full. Okay, all the cars that were to be produced in the first batch had been allocated, so all my mate had to do was wait and then pay the rest of the purchase price in due course. However, a few months later, he decided he didn't really want the sports car after all, but he's in the queue. He's paid a deposit. What does he do? And the answer was he sold his place in the queue to somebody else who'd missed out. What he did was he had a conversation with a chap interested in getting his hands on one of these limited edition sports cars, being one of the first buyers, and said, well, I've got a place in the queue that I paid £5,000 for. So I'll transfer that to you, and in those days this was possible, for £5,500. In other words, my mate was offering to walk away from his place in the queue for a £500 profit, the gap between the deposit he paid and the one he was about to receive, and give the other chap a chance to join the queue, which otherwise he wouldn't have had. Okay? So my mate and the chap taking his place in the queue had traded a sort of derivative, because a £5,000 deposit on a much more expensive sports car that's to be delivered months down the line is, roughly speaking, a call option. More about those a bit later on. So you can see derivatives get used and people don't even know they're using them. All right? So it's often the jargon that fools people when they turn to financial markets and think, well, this must be a new baffling type of instrument I'm never going to get my head around. And it's true, they are a bit conceptual, but remember that they are a contract whose value is based on an underlying something else. Now, in the example I just gave, that something else was a car. In financial markets, that something else could be some shares, could be a property, could be a commodity like gold, for example, could be almost anything. That's what makes the derivative markets so big and so exciting, is that almost anything can form the underlying basis for the contract. Just remember that. A derivative is not a product itself, it's not the car, it's a contract that derives its value from changes in the price of something else. Okay? Right, now this video is going to be a back to basics beginner's video, so let's take on some key issues and then I'll explain where you can get some more information later. Okay, first issue, how many derivatives are there? It's a massive market, but actually you may be reassured to know there are only 3 products in existence. All right, and those 3 products that form the basis for the entire derivatives market are the future or forward. A future is an exchange traded version of a forward contract, but they're essentially the same thing. An option, which I tried to give a sort of Mickey Mouse example of just now with my friend in the queue for a car. So future, option, and the swap. Now, at the end of the video, I'll give you some more information about where you can find out about the mechanics of these things, but that's not my job here. Let me just explain briefly what these are and how a private investor can ever get near them. Okay, so the professionals, the investment banks, for example, can trade these things quite happily. A future is a contract that simply tracks the price of an underlying asset without you having to bother about ever owning the underlying asset. It saves you the kind of hassle of having to store tons of corn and aluminium and so on. So a future, if you're looking at that and thinking, well, could I ever actually buy or sell one of those? The answer is it's quite tough in the UK for retail investors, but the nearest thing is a spread bet or a CFD, contract for difference. More information on those is available. I'll tell you where in just a moment. Okay, so futures, spread bets and CFDs, very, very similar products. Now, an option is something which gives you the choice at the end of the day about whether you buy or sell an underlying asset. It includes some flexibility that futures don't, and therefore you pay an upfront premium. all right? And the point about derivatives is they come in different shapes and sizes. So this is a straightforward contract that mirrors the change in price of another asset. This gives you the option to buy or sell another asset, hence the words call. In the old days in a pit, or if you're in Chicago, you'd still be in a pit, you'd call an asset across the pit or put it away from you. But that's options. And swaps, well, they allow you to change your exposure to something, all right, without having to get your hands dirty in the something. Now that could be a currency, an interest rate, or even an asset, all right? Now, all I'm trying to do here is just indicate that there are only 3 products in the derivatives market. All other fancy products created by banks and the like are some combination of those 3 planks, all right? In a moment, I'll explain where you can get more information about all 3. So, more importantly, let's say here, what are they used for? What is the point of all these fancy exotic products that are appearing in the press a lot at the moment with talk of a financial services transaction tax in Europe and so on and so forth, okay? Why the big excitement? And the answer is that derivatives can be used quite a few different ways. They are very flexible, and in the wrong hands, they're very dangerous, all right? But then so is my lawnmower. So let's have a look at what we could use one of these products for. All right, going to put some buzzwords up here. Number 1, gambling, speculation. All right, spread bets, futures and so on can be used to take a directional bet on anything you like, shares, commodities, property and so on. That is taking on risk. Ironically, you can also use them to hedge, which is the opposite. That's reducing risk. You can actually sit there as a fund manager saying, I've got 1,000 shares, I'm worried about their price falling, I don't want to sell them because I'll miss out on dividends and I might trigger tax liabilities. What can I do? You can keep them and use something like an option to hedge any fall in price. So without going into detail, you can also use them to reduce risk, okay? Traditional hedging, nothing to do with hedge funds really, reducing risk. The third use is what's called arbitrage. That's a horrible, fancy sounding word that may cause a few people to turn off the video straight away, but don't panic. Arbitrage is taking advantage of short-term price anomalies. That's a bit more technical, okay? But here's another example involving cars. A mate of mine used to import, when you still could, a certain type of car that I won't mention because the manufacturer is now stroppy about it, okay? Cheaper in Europe than he knew he could sell it for in the UK. So he'd go over to Europe, buy a load, bring them into the UK, sell them for more. Nice little trade he had going round the edge of the official dealerships until the manufacturer spotted what he was doing and closed him down. But in the meantime, he was buying cars for less than he was selling them. He was taking advantage of an anomaly for that particular vehicle in Europe, okay? And in theory, you can do that across all sorts of financial markets. Nick Leeson, for example, at Bearings, was taking advantage of the fact that one contract was traded in 2 different places, 2 different exchanges in the Far East at 2 different prices. And if you were fast enough, you could buy the cheap one, sell the expensive one, and make a bit of money, all right? And the fourth use, which I won't go into detail on, is you can create solutions using derivatives. Okay, structured products, which MoneyWeek we're not a huge fan of, are a combination often of derivatives to achieve a particular result. You know, you get X% of the rise in the FTSE over the next 5 years, or your money back. As soon as you read that kind of sentence, derivatives are probably involved, all right? Now, where can you get more information? Because that's a whirlwind introduction tour to the world of derivatives, okay? Futures, my video, what are futures, okay? Options, there's another video out there, what are options, and the retail equivalent, covered warrants. For swaps, see my swaps video, okay? And on structured products, no surprise, take a look for my structured products video, which explains in part why we don't like them very much. As for how you get hold of these things as a retail investor, spread bets are a bit like futures, covered warrants are a bit like options, and I'm afraid the swaps market is basically shut to you as things stand.